Okay, good morning, everyone. Hi, my name is Pranay Bhatia, and I am a tax partner with BDO in India. BDO in India is a uh, accounting firm focusing on providing tax, audit, and all other assurance services. Uh, and today I'm going to talk about some of the important India updates, and you can raise your questions or email me. All my contact data is already available with you and Jeff. So let me start my presentation by giving you some of the key economic indicators. Uh, India has been a continuously growing economy, and we have seen it in terms of the purchasing power parity, or we have seen the way, how quickly the GDP has been growing, and it's the fastest growing nation at this point in time. Urbanization is taking off. There are about plans for about 100 smart cities. There is a continuous increase in the per capita income. There is a continual fiscal consolidation which is happening. I think there are a number of factors which are making India a very attractive destination for investment, and specifically in last 2 years we have seen a continuous and an ongoing increase in the uh, in the opportunity to invest in India being expressed by a number of foreign investors. Before I go specifically into some of the tax and regulatory developments, I thought it would be important to bring out some of the key numbers uh, exactly demonstrates how important India is from the global economic perspective. GDP has been growing at 7.6%. We have foreign exchange reserves of in excess of $350 billion. There has been a fabulous FDI inflow in last 1 year. A number of initiatives have been taken up, which is either a Make in India or a Startup India or a Skill India. There is a continual tax reforms in terms of providing greater certainty. Reducing litigation is one of the key agenda of this government, and which is very much visible in some of the initiatives, tax initiatives which have been taken, which we'll touch upon during this presentation. Before I begin to take up individual developments, I think the single most important development is the signing of the protocol between India and Mauritius. The India and Mauritius Treaty has seen for a long time a protection for foreign investors from capital gains in India, and very recently, just in last month, Indian government has entered into a protocol with the Mauritian government, and they have agreed on a phasing out of the tax exemption. Just taking 5 to 10 more seconds on what exactly this is all about. India follows a source-based taxation, so that if the income arises in India, it is liable to tax in India. But in relation to capital gains under India-Mauritius Treaty, India had ceded its right to tax capital gains in favor of Mauritius. The tax department in India started believing that the Mauritius Treaty has been abused over a period of time, and therefore there is a need to take away this exemption. After about 10 to 12 years of discussion on the tax treaty, we finally have a protocol which says that all the shares acquired before April 1, 2017 will continue to be fully exempt from capital gains in India. Shares acquired after 1st April 17, up to 31st March 2019 will be liable to only 50% of tax rate in India. However, this will be subject to limitation of benefits clause, and a shell or a conduit entity will not be entitled to any treaty protection. There are some monetary thresholds which are prescribed. And from the fiscal year 2019-20 onwards, there is no capital gains tax exemption. This is the development, the single largest development which a number of investors, whether they are private equity investors, strategic investors, are focusing on and are concerned about. Just let me tell you now what are the open issues which are still there in terms of the revised protocol which is out. What is the main purpose test? What is the bona fide business test? What entity will be treated as a shell or a conduit are some of the open areas. They are not fully being defined in an objective manner, leaving some subjectivity and therefore interpretational challenges. Though these challenges are only in the period from 2017 to 2019, but these are important changes which must be considered. Again, what is expenditure incurred in Mauritius and in preceding 12 months? What does it mean? Are again causing some kind of tax challenges. A couple of other important issues which are impacted because of these changes. One is, will the GAR impact the interim period? The general anti-avoidance rules, which are becoming effective 1st April 2017, and how the Singapore Treaty will be impacted. Now, what is the relevance of Singapore Treaty with the Mauritius Protocol being signed? Singapore Treaty had also signed a protocol where Indian government has said, so long as the capital gain exemption under India-Mauritius Treaty continue, Singapore Treaty will also continue to enjoy exemption. With the revised protocol, it only means that come 1st April 2017, Singapore Treaty will not enjoy exemption from the capital gains exemption. And just to take it to the next level, we have already heard from some of the very, very senior officials that India-Singapore Treaty is also under renegotiation, and Singapore is also claiming some of the protection that is available under India-Mauritius Treaty. So only time will tell us how the India-Singapore Treaty and other treaty which provide capital gain exemption, how they will impact the investment philosophy going forward. This also means that we now need to relook at some of the investment structures that we have been using for some time, and it is extremely important that as we go ahead, we identify some of these challenges upfront and take care of this before the new investment period comes into play. At this point in time, I would just like to share with you some of the critical concerns being raised, and the most critical being that even if there is a period up to 31st March 2017, which is available for the investors to enjoy certain tax-free investment exemptions under India-Mauritius Treaty, will the general anti-avoidance rule impact the gain even though there is a protection under treaty? Now, to that effect, we do have some rules which say that CAR will not apply to certain transactions. However, the period is not specified to be 2017. We're making a representation to the Finance Ministry to clarify that any transaction effected before 31st March 2017 must also continue to enjoy exemption from the application of general anti-avoidance rules. So only a time will tell us as to whether we get this exemption going and whether we are getting any favorable response from the government and they actually amend the rules. But we are very hopeful about it. Going forward, I think it's important to touch upon some of the updates. Every year we have the budget coming up, and I think I have not taken all the changes, but some of the critical changes are here. There has been a promise to reduce the corporate tax rate from its current level of 30% to up to 25% in coming 3 years' time. So we are really looking forward to it. Having said that, keeping in mind the impact of or facilitating Make in India, if there is a new company which is set up in the current period, it will automatically start enjoying the reduced corporate rate of 25%. This is just to touch upon it. There have been various incentives for startups, whether they are the incentive for the startup itself or for the investors and the shareholders of startup. For everyone, there have been tax incentives which are provided. There is a regime now which is introduced, a royalty regime, which is similar to a patent box regime. So if there is a new invention which is based on some research and development work in India, then it will enjoy a reduced rate of 10% on the global royalty income that it earns. The rules have been specified for place of effective management. So if there is an Indian promoter who sets up a foreign subsidiary, there have been rules which are specified for the deferral of the place of effective management. A new dispute resolution has been notified, which allows all the pending disputes, whether they are before the tax authorities or whether before the court, to come and do a one-time settlement. There has been some development on uh, taxation of digital economy, and we are seeing that even the digital economy taxation is enjoying certain specific exemptions. India has, with this budget, introduced country by country reporting, and going forward, we will see that all the companies which meet particular turnover threshold will have to do compliance with CBCR. Let me touch upon it very quickly as to what exactly the law says. It has been introduced now as part of the statute. It applies to all the resident companies or those companies, even if they are not resident, but who have got their substantial parent which is in a jurisdiction which is not signed up for CBCR to be compliant with CBCR. A threshold of euro 750 million dollars, 50 million euros, equivalent to 850 million dollars, has been specified, which is the group turnover threshold. Reporting forms are likely to be in line with Action Plan 13, which is already OECD initiative, and the report has to be filed by the due date. This becomes effective this is already effective as we speak, and for non-compliances, there are penalties which are prescribed. Going forward, let me just quickly touch upon some of the transfer pricing developments. In terms of the statistics, there are more than 100 MAPs which are already being resolved. More than 60 APAs have been signed, including bilateral APA, which India is signing. There are a number of more APAs which are being filed and which are under negotiation. But I think what is commendable is that even though in terms of the APA regime, India is one of the new entrant, but it has got a very favorable time period within which APAs have been settled. And what is really good to see is that the recent judicial precedents or the recent judiciary is actually taking note of what has been agreed under an APA. So it has not only accepted the methodology which has been accepted under an APA, but also the FAR analysis and data principles are also accepted as part of the decision-making process based on what APAs have already been signed. So the APA initiative has really worked very well for foreign investors who are doing business in India. Moving on to the next development on transfer pricing, hybrid financial instruments, always face a challenge in terms of the transfer pricing as to what is the right rate of interest and what is the right compensation on these five financial instruments. The courts have consistently in India taken a view that borrower should be used as a tested party, and the applicable rate of interest should be looked at in terms of where the financial instrument is placed. So if there is a financial instrument is in a jurisdiction which uses LIBOR as a rate of interest, that's the right rate to look at it rather than looking at an India rate. So some of the basic principles have been again and again upheld in judicial decision, and I think that's a very, very favorable way of for any company to go. Let's touch upon a couple of more transfer pricing developments. Again, intra-group services have been a constant area of debate for most of the MNCs. And I think what has been done is there is an examination of benefits test, and documentation and benchmarking are given a tremendous consideration. So even if even if in a particular year you have not paid for intra-group services, and if there is a development now which satisfies the benefits test, and you are able to do your documentation right, you could still be able to claim deduction for intra-group services. In terms of the contractual allocation of risk, the risk allocation is now being looked at from three perspectives: control, financial capabilities, and financial strength. And that is why it is necessary for Indian research and development units to demonstrate risk-free profile if you are looking to compensate Indian R&D center only on a cost-plus basis. So it is the documentation and how the functions are being performed by Indian R&D centers are gaining more and more importance. Moving to the next one, I don't want to take you through the entire verbose slide that I have here. In terms of Startup India, there is a very detailed action plan which has already been laid out by the government. There is a complete simplification and handholding of the ongoing process. There is a funding support and incentives which are being done. There is also Indian industry academia and partnership and incubation, which is taken up by the government. There is a continuous focus to assist a number of startups. Even if when you look at some of the ongoing trade seminars which are going on, I think there is always a place which is dedicated for startups. There is a lot of interest on or focus by the government in terms of promoting startups in India. I think we're on our right track, but we see how it all shapes up. Let's look at some of the developments from the administrative perspective. So these two circulars which I'm talking about are both released by the Administrative Authority in India, which is Central Board of Direct Taxes, CBDT. Always taxability of unincorporated joint ventures has been a matter of debate, primarily because of the way the law has been drafted and the law has been administered in India. To remove some of these anomalies and to facilitate foreign investors to invest into India or to bid for projects, they have now brought in a circular which says that only if there is, following attributes may not constitute AOP, they have clarified. So where there are independent responsibilities and risks, performance-based rewards, and control and management, that's where they will not constitute AOP. It also says that it will not be applicable to members who are associate enterprise. So basically, it says just merely because you are an associate enterprise does not mean that you will become an association of person and therefore liable to tax at a unimaginable rates. There is a draft foreign tax credit rules which have also been notified, and I think that has gone way ahead in terms of clarifying some of the ongoing issues. The rules are still in the draft stage, and we are hoping that if there are any issues with these rules, it will get all ironed out before the final rules are circulated and implemented. Now let's look at some of the regulatory developments. The FDI in e-commerce, which is a foreign direct investment, earlier it was not permitted in B2C e-commerce, which is now permitted. 100% FDI is also permitted under the automatic route in marketplace model of e-commerce. FDI is not permitted in inventory-based model of e-commerce. One of the critical relaxation in terms of swap of shares. So earlier, swap of shares of an Indian company for a foreign company required an approval of Foreign Investment Promotion Board, which is now not required. Manufacturer is permitted to sell its own products through wholesale, retail, and e-commerce without the government approval. These are the two very, very critical relaxation. I think third most important is investment in LLPA. And I think, why it is so important. I'll just move to the next slide, which gives out the parameters and a distinction between a private limited company and a limited liability partnership. 100% investment is allowed in a private limited company, whereas in LLP, 100% foreign investment is allowed where there is no sector-linked investment conditions. Private limited company can raise money from public listing, post conversion to public company. However, liability limited partnership cannot do so. A private limited company can avail external commercial borrowing. LLPs cannot avail. Cost of formation is of course lower in an limited liability partnership. And I think the most important distinction is the application of dividend distribution tax. Every company which earns profits after it has paid corporate tax is additionally liable to pay dividend distribution tax. Whereas in a partnership structure, a partnership, once it earns profit, is required to pay one level of corporate tax, and the distribution thereafter are not liable to distribution tax. Now, this is not exactly similar to LLP taxation in US, where LLP is generally a pass-through entity, but the important point is that there is only one level of tax. Now, each individual partner may not be able to enjoy the tax status which it has of its own, but still there is only one level of tax, which is corporate tax, which is not the case in a private limited company. As a shareholder, you have three levels of taxes. One, a corporate tax at the company level, a dividend distribution tax in the hands of the dividend paying company, and if you're an individual shareholder, then an additional income tax on the dividend income if it is more than ₹1 million. So I think it's important for all of us to understand this difference. And as we talk, there are more and more foreign companies who are saying, should we explore an LLP route to invest into India rather than a private limited company? Even the existing companies are looking to convert themselves from a private limited company to an LLP. Now, looking at the next level of challenge some of our foreign clients are facing is in terms of the cash accumulation in India. Typically, you will have a subsidiary in India, which will be a cost plus entity, and all the margins that you pay to meet the Indian transfer pricing regulation will keep accumulating in India. Till the time you have expansion plans in mind, the amount that you accumulate in India will be spent out, and therefore you do not feel the heat of the cash accumulation. But as you stabilize your operation in India, the margin that is paid after tax starts accumulating. Now, any distribution has two issues, because you are generally set up as a private limited company. The distribution of the accumulated cash suffers some kind of a tax. Second, considering the fluctuation in the foreign exchange, you sometimes tend to lose out, and sometimes tend to lose out big time on the foreign exchange difference. So a lot of companies today are reaching out to us saying that how can you help in terms of cash repatriation, and that's where we have just brought out this two principal ways of repatriation. One, the more conventional ways, which are dividend, royalty, buyback, capital reduction. All of this has some or the other tax implication. And now more advanced or restructured versions, which are either a bonus preference shares or a capital structuring or a cash adjustment, cost sharing or margin analysis. These are some of the important aspects which are gaining more and more importance or consideration from foreign investors. I've just divided this into 3 or 4 large boxes, as to what exactly it means in terms of the taxes, uh, and yeah. So the dividend or the buyback, they are the popular and the simplest manner of income repatriation, but it has got its own transfer pricing challenges and a tax liability in India. Capital reduction, on the other hand, is a less preferred but an important alternative, and it's a court approval in the for capital reduction is mandatory. Capital restructuring, bonus preference shares are some of those alternatives which needs a detailed evaluation, both from a corporate law perspective and from a tax perspective. And recharacterization of reserves and redemption of preference shares could be explored to achieve lower effective tax rate. But it is again a fact specific. Each case will differ on its own requirements, and the outcome is only possible is visible only when you see the financial data. On the other hand, cost sharing or margin analysis are gaining more of focus and attention, where a transfer pricing driven solution can be achieved. However, this will need to be reviewed in terms of the global transfer pricing policy and how the functions in India can be structured so as to have a fair allocation of costs and margins. So as we come to the end of this presentation, I think there are 4 or 5 key areas which every Indian company, or if a foreign company has an Indian subsidiary, you must look out for. One of them is the place of effective management, and it is important to understand that if a Indian group is setting up any foreign subsidiary, or the foreign companies group has a lot of Indian directors on the table, how does that impact the effective management of that entity? Country by country reporting is another OECD initiative which we have spoken of. FATCA compliances and CRS compliances are in full swing, and a lot of financial institutions, are our clients whom we are helping. Income computation and disclosure standards are the new standards which have been prescribed by tax administrator, and that kind of completely redefines the way the things are going to be taxed in India, and it is going to be the next important development and could be a source of long drawn litigation. And we will also have the bilateral APAs to put at rest some of the ongoing issues. With that, I come to the end of this presentation. All my contact details are here, and you can reach out to me at any time in relation to any India query, whether it be tax or regulatory or what have you. Thank you so much, everyone, for listening to me.